Hello, everybody. This is Justin Krupp with Ground Floor. We are going to give it maybe another 2 minutes or so. I see a lot of folks are still coming in. East Coast time, noon here, so maybe some folks are grabbing some lunch. Everybody else may be grabbing a late cup of coffee. But inevitably with some of these, everybody fires up the GoToWebinar and it has to do a fresh install. So we'll give this another 2 minutes and then we'll get going. Well, I think in the interest of time, we've got about 3 after the top of the hour. We're going to get going here. I'll at least go through some housekeeping items for the webinar today, as a couple other folks probably inevitably trickle in. But really do appreciate everybody taking the time out of their busy days to join us for this fireside chat. We're thrilled and honored for you to join us. I'm thrilled to introduce Brian Daly, CEO and co-founder of Ground Floor, and joined by David Sisman, professional investor and lead investor in Ground Floor via WeFunder. We've got a really good agenda today, broken out primarily into 3 parts. The first piece that we're going to kick off today is going to be Brian taking us through the details behind a pitch. And then the real crux, the real main part of our agenda today is going to be the fireside chat, where I will volley some topics to the guys here, and we're really just going to listen to hear what they have to say. And I think that's really where the value add is going to come into this section. We are going to allow time at the end, maybe the last 15 or 10 minutes or so, for a Q&A. So for those looking at your control panel on the GoToWebinar, you should see one of the gray drop downs that say questions. So as things are progressing, and if you have an idea or a thought and you want to share it, please put your questions into that section, and I will be monitoring that as we go on. And we'll have that last section where I'll throw some questions consolidated to the guys here and have them answer those accordingly. And then please stick around also to the very end, because I'll bring us home for about the last minute, where we'll talk about a promotion that we're going to run that's going to be exclusive to registrants and attendees for the webinar. So with that, I'm going to hand it over, Brian, to you, and you're going to get us going.
Great. Thanks, Justin. As Justin said, I'm Brian Daly, co-founder and CEO of Ground Floor. Apologize for my congestion in my chest today. I woke up with that and I'm working through it, so bear with me. We really appreciate all of you being here. And I just want to say on behalf of our 102 employees, 6,500 shareholders, and 200,000 customers, who include many of you, I'm really excited to share the details of our current round of funding and invite you to invest. You're all familiar with Ground Floor and our products at some level. From a company perspective, it's important to step back and realize Ground Floor is first and foremost an investment technology platform. The platform provides independent real estate developers with debt and now equity capital. The secret weapon and special sauce for how we do that is all of you, our army of individual retail investors who serve as the source of this capital. We're going to get to that in a moment. But first, at a high level and as an overview, we've now scaled the business over 7 years of operations to $24 million in revenue. Our investors have collectively put almost $1 billion in capital to work. And most importantly, for you as an investor, we've built a highly profitable customer acquisition engine. As we may get into when we open it up for discussion after this presentation, this last point is really important. Raising capital as we are now to invest in the growth of our investor base has been shown to have a very positive return over time. The reason we burn cash is to accelerate this investment in customer acquisition and product development at a level beyond what our current level of profits could afford. That speeds the process of getting the company to a scale that someday might allow us to go public sooner than we otherwise would. This chart shows our growth trajectory over the years. Last year, you can see we scaled to $14 million in revenue. We've grown at a compound annual growth rate of 62% since 2018. I will say this year we're on track to have a similar sort of growth rate despite everything you read in the headlines, and that's since 2018. This year, we're on track to achieve $475 million in investment volume. Our business thrived through COVID, and now we're positioned to gain share and accelerate growth as the Fed raises rates and capital markets tighten up for our competitors. I mentioned before that the retail investor is our unique secret weapon. The main driver of our growth is the enormous multi-decade tailwind of mass market retail investors moving into alternative investments. These are not the sort of investments that you can buy on Robinhood or Fidelity or Schwab, and it's a tectonic shift that's showing up in many categories, such as art, wine, collectibles, and the reason we're here today, investing in startups as well. Residential real estate is 10x the size of most of those categories. 10x is familiar to all of us, and 10x more liquid. That's why the product works. Our products solve the most important problem in alternative investing, which are liquidity on one hand and concentration risk on the other. Now, if you're a user of the platform, you're probably interested as you think about investing, how does it work behind the scenes? Well, first, we provide capital to real estate investors. That capital pre-funds the loans that we originate with money that's supplied by all of you via ground floor notes and our Stairs app. Second, our regulatory tech stack moves batches of securities that we create out of that process through the SEC qualification, and that regulatory oversight that we get and that we've earned over time. It took about 4 years in the early days of the company to establish that foundation. That's unique among platforms. There are a lot of platforms that might sound like ground floor, but none of them offer the level of open disclosure and accountability via regulatory oversight that we do. I mean, how many platforms or startups can show you 7 years of audited financials? That's very, very unusual and very valuable. Third, investors allocate capital to the securities they choose. It's important that ground floor isn't a fund. With us, all of you get to be the bank and your own fund manager. We provide tools that make diversification quick and easy. And for those of you who use our automatic investing tool, it becomes pretty effortless to keep your capital invested. Lastly, the last step of this model is as investors fund the loans on our platform, our capital is replenished so we can put it back to work, earning origination fees and bringing more investments onto the platform. The product is so sticky and successful that we've never seen the amount of capital on the platform for any annual cohort shrink in aggregate terms. That's what we say, we call it negative AUM churn. Even at 3, 4, 5 years and beyond from signing up, the average ground floor investor portfolio is growing, not shrinking. This creates a lot of ballast for our growth. And as you'll see in a few slides, our business can continue to grow without raising additional capital, but the additional capital supplied by this round, when you buy our stock, that accelerates and magnifies our growth. Now, we have a multi-channel revenue stream that monetizes our investment capital at a rate that's high enough to throw off over $66 in revenue and $30 in profit for every $1,000 invested on the platform. That's without charging any fees to our investors. And that's important because we think if you're taking the risk, you should get the full benefit without ground floor clipping a piece of it. Now, the way we make money instead is first, we charge fees to the recipients of the capital that we provide at the time we provide it. Those are origination fees. That's the lion's share of our revenue. Second, we earn interest on loans from the time we pre-fund them. We hold them on our balance sheet until they're purchased by investors. And then third, we collect servicing fees from developers as we manage the asset through repayment. Now, as this chart shows, we've seen occasional dips in investment volume and revenue over the years. This usually happens when we need to pause to reset lending criteria or to rebalance supply and demand on the platform. As you can see, our growth in 2022 has been especially strong. In Q3 of this year, it's July through September, as we did during COVID, we took a pause to reset our lending criteria and to allow investment volume to catch up with the surge in origination volumes we saw in the first half. Now, catching up usually requires about 3 to 6 months, and this year is no different. I said at the outset that ground floor stands to grow more from the current environment of high inflation and expected weakness in the price of houses, and here's why. As a provider of debt, our investors are protected by having recourse via a first lien to the underlying house in the event a borrower doesn't pay. Meanwhile, our customers, especially experienced developers who borrow money from us, they actually make more money during a housing cycle like this by being able to buy low, and then we can control risk as a platform by limiting the amount of leverage that we provide. That is, the amount we lend relative to the value of the house. Now, we know interest rates are increasing. Now, what's the impact of that? A lot of people ask us that, and I think it's a nuance, but it's important to understand why that's actually beneficial in a lot of ways. First, developers have fewer competing alternatives. That's great for us. It's counterintuitive, but we get to increase credit quality now more than we would get to during quote unquote good times. Our investors also benefit from earning higher yields as we leverage our strength to charge higher rates. And lastly, equity capital becomes more expensive for our borrowers, which increases demands for our loans, while also creating an opportunity to profit from new opportunities to fill the gap and allow our investors to participate in the equity while they also get to buy low. In summary, COVID demonstrated how we as an intermediary creates value by matching supply of capital with demand throughout market cycles. Our unique value proposition, not replicated really by anybody else, it's a huge competitive advantage to have retail capital on our platform, and that's especially true when traditional markets are challenged by economic conditions like right now. Now, I mentioned before that the company is fully capable of continuing to grow without raising more capital, and that's because of this self-reinforcing business model and our sticky product. We project that our current investor base will, if it turns out the way that it's turned out over 7 years of operating history now, we project that they'll invest $900 million in capital by 2025. That's that green sort of area right there. Deploying the capital that we raised in this round to accelerate and add to customer acquisition that, beyond what we'd be able to do otherwise, will enable us to increase our growth through the acceleration of new product development along with that investor acquisition. So we project that will build us up to do over $1 billion of investment volume in 2025. So quite a difference. You can see why we go out and raise capital the way that we do. Now, how does that look on the financial statements? I'm not going to go into all the details here. This slide is available on our WeFunder page. But you can see that in 2025, we project that doing that $1 billion in investment volume can be expected to bring in about $80.4 million in revenue and allow us to generate a profit of $6.1 million. What does that mean for an investor in this round? You guys. Well, right now we're offering shares at a price that reflects an enterprise valuation of $243 million. That's a multiple of 12.5 times our last 12 months of revenue as of June 30th, 2021. That's when we prepared to open this round. Of course, we're continuing to grow. So by year end, that multiple is going to ease off to something just north of 10x. So that's a good deal for you. relative to the 12x. Now, if we expect over time that multiple is going to hold up. We think we're building a unique asset that the public markets and Wall Street is really going to value highly. If we hold that multiple constant at 10x, then our enterprise valuation is going to grow to $805 million. If you factor in some dilution from future fundraising that we're likely to do, I don't think we have to, but if we do that, you can see our way kind of to a share price that increases 3 to 4x from here. That would be a sort of a price of around $131 to $175 in 2025. Now, is 12.5 times revenue or 10 times revenue reasonable? Every investor's got to decide that for themselves. But I'll tell you, measured against comparables that we look at, such as Start Engine, Fundrise, and WeFunder itself, and we use publicly available revenue and valuation data for that. Ground Floor's multiple is less than half to 1/3 of the valuation multiples being demanded by those companies. So we're roughly the similar scale and growth rate. So we think our pricing represents a really strong value for investors right here, and that's very purposeful because we're looking for our shareholders to make money on this investment. I'm almost wrapped up here. I'm running to the end of my 15 minutes to get through this part of the webinar. When you invest, you're going to join notable investors that include the founder of ICQ, which sold to AOL in 1998, a retired U.S. general partner of U.S. Venture Partners, and a former board member of the publicly traded REIT Avalon Bay. Our Series A round was led by FinTech Ventures back in 2015. And today, up on the slide as well, we have David Sisman, who's a professional investor who spent much of his career at HIG Capital, and he invested in our very first round of financing way back in 2013. So I'm excited to get to the next part of this presentation where we'll get to hear from David and include you guys in on a chat that we're planning. So in summary, Ground Floor has a strong position, great momentum and scale. That's a perfect time to join as we reach the next inflection point in our growth, and I hope you will. We are, as of our previous round, we're at 6,375 shareholders. That continues to grow year over year. We're incredibly proud that our customers own 30% of the company, and we hope that you'll join that group or decide to add to what you already own in the company in this round. Thank you.
All right, thanks, Brian. As Brian had mentioned, that presentation that he had gone through is available on our WeFunder page, but I think to hear the commentary, Brian, from you directly is invaluable. So appreciate that. So let's move on. We're going to move on to really the core component of our time today, which is the fireside chat. And so really going to open it up to you guys, and I'll act as moderator here and throw some commentary your way as conversations conclude per topic. But Brian, you had mentioned a little bit ago about David and him being at the Ground Floor, pun fully intended, back in 2013. So I think maybe we start there. Let's start with your guys' background, how you met, and then I think the transition there, David, for you would be what you saw in the company then, and then maybe also add in sort of more of a broad commentary about your background as an investor.
Yeah, David and I both found ourselves living in Naples, Florida, back in what, David, 2008? I think it was 2009.
2009, late, yeah,
2009. And we met through a couple of ways, actually, through a networking group there. We both went to Harvard Business School and ended up at a Harvard reception. That was what, David? That was 3 years before I started Ground Floor, or even had anything close to the idea. But we were talking about business ideas a lot. You want to sort of comment on sort of what you were thinking about at the time and share some of your background and how we got talking about what eventually became Ground Floor?
Yeah. Well, so I was living in Miami prior to 2009, and I was working for a private equity firm called HIG Capital, and then a hedge fund that HIG raised. And my office was literally surrounded by new condos and new office buildings that were going up in the housing boom. And we were wondering who's buying all these places. And so I had a front row seat for the housing bust in 2007, 2008. And so I had spent a fair amount of time thinking about housing and housing finance. And by 2009, 2010, the entire, especially South Florida, was constipated with, just the housing market was constipated. Nothing could happen because the only way you could get a transaction was either the outright sale of a house, which would involve a mortgage, and the mortgage qualifications at that time became much stricter, or a short sale, which is, anytime somebody has to do a short sale, it's a long bureaucratic process with a bank. So, I had been toying with, this concept of, well, why isn't there the potential for an equity investment in a house? So somebody could come in and be, effectively a co-investor with the owner of the house, because these are long duration properties, right? The house is going to be around, the value is going to be there. Who knows how long it'll take, but there should be another product. And so that was going through my head at the same time we met, and then you went off and you founded Republic Wireless for bandwidth. And if for most of you on this webinar won't know what Republic Wireless is, it has nothing to do with the housing market. It was, as far as I know, the first cell phone system over Wi-Fi. So the backbone of the calls would be over Wi-Fi most of the time, bringing down the cost. And Brian was brought into Bandwidth to start that from scratch. So what is now Republic Wireless, and it's still around. At the time I had met Brian, it did not exist. There was nothing there. He left to go start it. This involved hardware, software, telecom, marketing, customer service, everything. And all of a sudden, like a year and a half later, it existed and was successful. And then he was talking about leaving. And I was like, what, who is this guy? Who goes and often starts something like this and then leaves? So after he left and was looking for, thinking about his next entrepreneurial venture, we were talking a lot about the housing market. And, I threw out to him the idea of investing equity in somebody's home. And Brian went off and ran with it and looked into it. And he came back and he's like, yeah, that can't happen. It's like from a regulatory perspective, like it just won't work. It just won't fly in our current mortgage finance world. But along the way, he met a lot of interesting people. He, explored the crowdsourcing industry more, met Nick, I believe, who was the other co-founder, and came back and said, well, what about this idea of first lien loans for fix and flip properties? And I really liked that. I mean, it was first lien, high interest rate, short-term loans, potential for diversification across the country. And I was like, okay, I'm in.
Yeah, and it was a lot of fun batting around ideas in the early days, and I was very fortunate to meet Nick. Nick, as many of you may know, if you've heard the story, worked on Title III of the 2012 Jobs Act, lobbied the Senate for it, wrote parts of it, was in the Rose Garden when President Obama signed it, and he's just one of the luminaries in the area of kind of private capital markets liberalizing and opening up opportunity to retail investors. Without his expertise, we never could have created a product, and it did take us 3 or 4 years to sort of get the regulatory approval, or foundation set for us to do this. So it was a pretty heavy lift. But yeah, those were great early days. I guess then, David, I ended up hitting you up for an investment at some point. I think over lunch in I don't know, June of 2013, maybe somewhere in there.
That's probably about right, because I think the initial check went out in October of 2013. I was looking that up today.
Took me a while. Took me a while to get the check. Yeah, for sure.
So, question for you guys then, David, maybe you take this one, but Brian, you probably have some thoughts as well. So from a ground floor perspective, obviously you guys met and you thought that there was a really good idea, but David, maybe take us a step higher when you're looking as a professional investor and when you're analyzing companies as a whole. What are you looking for as far as what beyond the idea do you think makes for a good investment, and particularly maybe elaborate on the different stages, early, startup, early stage, right up to that pre-IPO inflection point.
Well, let me go even further, because in my current job, I invest in very well established companies that are traded in the public markets, that often have hundreds of millions or billions in revenues. And what I do day in and day out is invest based on cash flows. I'm a cash flow based investor from a professional perspective, looking for lack of a better phrase, cheap stocks, sort of Warren Buffett style buy and hold. So I'm very comfortable holding stocks for a long period of time, and these are publicly traded ones where there is liquidity along the way. So, but from a personal perspective, I like also to explore different areas that frankly make me a little uncomfortable, because when you're talking about angel investing, which I did in 2013 here, it couldn't be more opposite of what I do day in and day out, right? There is nothing to go on, right? It is maximum uncertainty with the widest range of outcomes. And believe me, I've invested in, I mean, I've made an angel investment before where 6 months later, the feedback was, yeah, it didn't work, you lost all your money. And it's like, oh, okay, thanks. And at that point, there's key man risk, there's organizational risk, there's product market fit risk, and then specifically for ground floor, it's like, okay, who is going to borrow this money? And then how do you get a website going? And then wait, you're talking about going and engaging with the SEC and opening this to non-accredited investors, which has never been done before, and how long will they take? And will investors on the platform show up? And essentially the investment comes down to, do I trust this management team to break through every wall and make good trade-offs when there are alternative paths to take? And that's why I bring up the whole Republic Wireless thing, because I had seen Brian do it. Like at one point in my diligence, I actually went and checked the Republic Wireless website and looked through some of the customer service forums, because it's a little bit hard to believe, but this was somebody who could be trusted to take the capital that I was entrusting them with and do something productive. And so they certainly did that. And then as there were additional rounds along the way, and at every point along the way, I would ask myself, well, what have they done? Have they made progress? Have they, even if things didn't go according to plan, was there forward progress, right? And so along the way, I can go through a laundry list of signposts where they started out only being in Georgia, and then they had to get SEC approval to go into more states, and then they got approval for non-accredited investors, and then they had to gain investors to actually invest in these projects. They had to get the borrowers. This two-sided market is constantly you're constantly out of balance, right? Just by definition, you're never going to be perfectly in balance. So seeing those trade-offs, SEC approval for more states, creative marketing to attract more investors, the invention of the notes product for people who didn't want to pick individual products and wanted a certain time frame and say, I want to be paid back in 3 months and I want that level of certainty. The development of the Stairs app, improvements in the design of the website, like the automated investing, pivoting from institutional capital to retail capital in, what was that, 2020?
Involuntarily.
Yeah, and even like these rounds of the crowdsourcing of the equity, the first crowdsourcing of their own equity was on their website, as it should have been. Then Seed Invest, now WeFunder. It's all of these things along the way where my level of confidence has gone up, and I've been able to see that all along the way because I actually started investing on the platform, I think in 2015, once you basically had a website going and I could figure out how to do it. So it was I've kind of seen the whole progression, and as a user and as an equity investor, I've been very pleased. Just to get to where, Justin, where you asked about, like, where thinking about pre-IPO investing now,
Right.
now I think about it of layers. So if you think of the chart that Brian showed of the cohorts of the AUM, the multicolored chart, think about that of their core business now is residential fix and flip. And there's definitely something of value here because they've overcome all these hurdles, are growing nicely just in this market. And when you look at the markets where they have the most experience, the sub-markets, because of course real estate is local, so the individual metropolitan areas where they have the most experience, are they, how profitable are they in those markets where they have the most scale? That looks very nice. And if you back out the money that they're spending for additional development, additional programs, additional markets, they would be even more profitable, and they would have, profitable. The net income would be positive before 2025 on the projections Brian showed. So the core is great. Then the layers on top. Do they have avenues to expand beyond the core business? Because to go public, you're going to want to show a growth story beyond 2025. And so what are those markets? Those markets may be rental, they may be multifamily, they may be commercial, they may be equity. We may get to the original, product that we were talking about. And then finally, are there any signs of them slowing down? And there hasn't been any signs of that. So that's why I'm here. That's why I'm investing in this round, because they're hitting on all of these things that I'm looking for, and the value proposition is excellent.
Great, appreciate that. And maybe you've kind of answered this to some degree, but maybe a qualifying question would be as you're looking at investment opportunities, pre-IPO investment opportunities, obviously we're talking a lot about ground floor, and you've done a great job explaining some of those toll gates, but is there more of a macro question for the folks on the phone, maybe not so much rooted in ground floor? Is there what maybe some of those other toll gates that you're looking at a certain point in time when an investment opportunity is presented?
It kind of goes to what I was just saying of the ability to have multiple avenues for growth beyond where they are now. And so there are, and Brian can talk more about these, and they're already working down that path of whether it's rental or debt for equity swaps, or I'm not sure you've dabbled in commercial, but I know it's on the horizon at some point. There's one other thing I would point out at this point right now, because there's been such carnage in the tech world, in the public markets. there are a lot of companies over the past 10 years that have grown with excess of funds. So they have not had to bootstrap things. And they're going through growing pains right now. I would say from a negative perspective, they've already grown so much. And because their business is slowing down or contracting, they have to lay off people and go through the pain right now, and you're seeing that some reflected in public market valuations. In the case of ground floor, it was much more, the growth has been much more measured of, building the foundation slowly, some by design, some by, just the nature of what they were doing in the regulatory environment. They couldn't go out and deploy all sorts of capital willy-nilly because that's not the way their system works. So they were disciplined by nature in the way they built the company, and I think it establishes a much better foundation going forward.
Great, appreciate that. So maybe the final chunk of conversation here for the fireside chat portion is let's talk about where the market is right now, talking about the housing industry, the macroeconomic conditions, particularly how it maybe compares to what we have seen back in the '08 timeframe. And so, Brian, maybe you could kick this piece off.
Sure.
Give us your thoughts at the macroeconomic level, but obviously particularly how ground floor is managing that.
Well, say, when we're out in the market talking to operators, who are buying property and, looking for capital to acquire it, and then renovate it, or if they're a builder to build it, the number one limiter in their business over the last 2 to 3 years in particular has been trying to find houses to buy, and the good ones will tell you that they've got a pipeline. The pipeline is so big that they can't even work on all the houses that they can buy. And so, they'll buy 10 houses, they'll sell off 3 or 4 of them to other investors at wholesale without doing anything to it. And then, they'll work on the 3, 4, 5, 6 houses that they were able to buy. And one of the main limiters in their business in terms of how much return they've been making is in how much they've had to pay for those properties. So the data shows that back in 2009, 2010, 11, 12, it may have been really scary to buy property during that time, and it was, and it may have been really hard because capital wasn't really available. If you had the capital, it was a great time to buy. Now, we think that's true now. We see the housing market rolling over, and I don't think we have anything like the credit crisis that roiled markets in 2008. We're not seeing a broad-based nationwide credit crisis that impacts every segment in every market. Instead, we're seeing markets, prices in markets that are regressing to the mean. So, markets that got ahead of themselves, right? Just too much demand chasing too little supply. But that's a really good thing for our customer. And it's actually a really good thing for the company because there's less competition to provide that capital. So guess what? We actually get a kind of our pick of the litter, right? We can tighten up criteria for borrowers even more than it might have been before. We can reduce leverage, right? So we're lending less money relative to the value of the property, and we're charging more, right? So this is exactly the kind of market where you want to make sure you have capital and where you want to, take advantage in order to deploy it. And that's how we view this opportunity. Now, we also have a portfolio, right? And that portfolio, we're aware there's going to be more defaults, there's going to be more workouts, there will be more principal losses, right? But we feel very confident, having stress tested the portfolio, that we're in a very good position, mostly because we've been well positioned all along, right? In lending on houses that aren't at the top end of the market, they're typically in the first quartile below the median, and that are in highly advantageous markets like Atlanta or Jacksonville. We have a lot of properties in those two markets. So we feel like the company is well positioned. And I'll tell you, this is where, if you didn't realize it before, you realize why it's good to be the bank. It's good to be a debt investor, because you're not concerned as a debt investor or a lender with where the price actually ends up, so long as the exit price is sufficient to repay the loan and the interest and the costs, right? And we find that in the overwhelming majority of cases, the product delivers on that. So I think if you look at our current portfolio, we feel confident about that, even if we certainly will have higher rates of default and higher losses, but the net result is still very, very attractive as an investment proposition relative to anything else you can find in this market, in our view. So we actually feel like this is a key moment for the company to hit an inflection point over the next 2 years.
Appreciate it. Wonder maybe, Brian, if you can expand on the key markets for ground floor. We've mentioned Atlanta and Jacksonville, and I think, David, you had mentioned earlier about some of the key toll gates that you're looking for that make for a good pre-IPO investment. And maybe, Brian, to that point on the geography, talk about sort of scale, like how the company looks at individual markets that
Right.
maybe are ideally outperforming at the national level.
Well, look, so we have a rigorous review of demographic data. We are very intentional about where we put our efforts in terms of originating loans. We want it to be a complementary set so that even if one market suffers, other markets will benefit. I'll give you an example. One great thing about Jacksonville that a lot of people don't realize is how diverse that economy is in terms of governmental jobs, tourism jobs. That's very different from a place like Raleigh or even Atlanta. You know, where Atlanta, there's a lot of Fortune 500 jobs, there's tech jobs. Raleigh is dominated by a lot of tech jobs. Austin is, you know, so we look for a mix of markets that meet our criteria for liquidity and price and, you know, 25 other factors that we weigh. And we've selected 13 of them where we're focusing our efforts. So we dispatch salespeople to go to real estate meetups and seminars. We, you know, work with mortgage brokers who work in those areas, right? We're very active in driving volume. Now, it takes a long time because a lot of our business is repeat business and and referral business. So during COVID, we were very focused on Atlanta and Jacksonville. Well, it's purposeful. Well, by consequence, there's a long tail to that business, you know, because we're seeing referral, you know, traffic. We're seeing repeat business from those bars that we've worked with in those markets. And as we get new markets started, you know, we'll start to see volume grow in those markets as well. But we're aware, you know, it's not a quick process, right? It takes a while. I think if you fast forward to 2 years from now, you'll see, you know, probably half a dozen markets that are represented at the same level that Atlanta and Jacksonville are today. So that's how we think about it.
Great, appreciate that. All right, so we are nearly at quarter till. So I think while we could probably continue this for a whole other hour, I think let's move on to at least the Q&A portion. We've got some questions that had come in and some that were queued up in advance. So I'm gonna kind of call upon one or the both of you and feed you guys some questions. So the first one that we've been tracking is Brian. I think this one is a little bit more catered for you, which is if you can speak to year-to-date revenue and maybe compare it year over year, and maybe where you can look into that crystal ball and see where things are going to conclude at the end of the year.
We've actually become, at this stage of our growth, pretty adept at forecasting and anticipating where revenue is going to be. And that's been really constructive for us as a company to plan resources and not get caught by surprise. You know, to answer the question very directly, our year-to-date revenue, you know, this time last year was sitting at $8.6 million. Of course, you guys see that we ended up finishing at 14. So far this year, we're at 17 million through September. So, you know, we're growing at a really great clip, and, you know, we're on track, you know, to finish around 24 million dollars at the end of the year. There are a few things we're doing right now that will have an impact on whether that looks more like 23 or more like 24, but that's a fair range that we feel pretty confident about.
Great, thanks. All right, so this question I think is probably for the both of you, and you in your different perspectives. I think will be unique based on your answers. So to both of you, and maybe David, I'll cue you up first, and then Brian, you can come in. What do you guys think about the competitors in the space? I think David, you had mentioned a couple players earlier. Brian, you as well. So maybe what are your guys' take on the competitors? And I think to that point, what you see as being a unique perspective from Ground Floor's end.
Brian, you want me to take that first?
Sure, yeah, go ahead.
So
you're more objective than I am.
well, so I could go down I'll get to the value proposition laundry list in a second, but I think I remember in like February of 2021 when it was like all about GameStop and that was going crazy, and Wall Street bets on Reddit and NFTs and then Rally Road. And I texted Brian and I'm like, what are like these people could put their money in Ground Floor and get 10% and like just like what is going on here? Like, why is there this excitement about crowdfunding into what is effectively a collectible that you'll never see? Like you could see it, I can see a sports car on the internet too by Googling it. I don't have to put my money into it and hope that there's a greater fool out there that's going to pay more for it. So, I mean, that's sort of my broader view as a cash flow based investor of saying we're just like NFTs and a lot of things that are based on greater fool as opposed to the cash that can actually be generated out of a business or a property or a unit or whatever. And so it just seems so clear to me that something like Ground Floor, I think I said to Brian at some point, every generation has to figure out how to lose money their own way. And then they figure out that, oh, there's a different way that I actually can make money. Oh, sorry, it's boring, but it actually works. So, the value proposition is unbelievable. Like, historically 10% 10% returns for non-accredited investors, so that with a $10 minimum, so investors can build a diversified portfolio with $1,000 into specific projects that are short-term in nature, so that you're going to be getting your money back in a relatively short amount of time. And if you're diversified enough, then it actually creates a nice income stream because you can't tell exactly when it's going to return, but on average, you'll get a certain number every month. There is a social element, a social benefit element of this, that where we need more housing, and these are in many cases dilapidated units that need to be rehabbed and provide more housing out there. And if you don't want to pick your own properties, Ground Floor has developed the notes products. And then furthermore, there's more transparency and disclosure than anyone else because they go through the SEC. So, returns, diversification, transparency, flexibility. I mean, there's, from time to time, I look at alternatives, whether it's Rally Road or the ones that's investing in wine or other things like that, or even other real estate platforms. And I just say, I don't know, I'll just keep on putting more money into Ground Floor.
Yeah, I mean, there are a lot of companies that sound like Ground Floor. When you look under the hood, you realize that most of them took the shortcut, easy path to set up an accredited investor platform. And we can go for those investors as well. We compete for them, but we have a stronger value prop because we have a lower minimum investment and we have this kind of SEC level oversight, the audited financials and the like. And then you hear about a bunch of others that are available to non-accredited investors. One that people have heard of is Fundrise. Well, I got bad news for you. If you're a Fundrise investor, you're investing in a fund. And when you invest in a fund, the fund manager is in control. not you. There's no barrier to entry to create a fund. There are plenty of them. You can look around. I mean, they're publicly traded REITs. The world doesn't need another REIT. And when you invest in one that's not publicly traded, if you're in one that's publicly traded, the public markets can discount that REIT. If you're one that's not publicly traded, like a Fundrise REIT, the manager's in control about not only what's invested in, but also when you can have your money back. So for example, if you asked for your money back out of the Fundrise REIT, as I did, because I invest in all these platforms personally, in December 2019, I didn't get my money back until July of 2020, because for the good of everybody in the fund, they paused redemptions. There was another one called Realty Mogul that some people have heard of. I didn't get my money back from that one for 2.5 years. So with ground floor, you have control, right? You may have a loan that goes late and you're not going to get capital back on that loan until the loan repays. But if you're doing it right, you're using the technology right, you have a broad portfolio that there's always something paying back. We don't control when you get your money back, right? The repayment of the loan does, and that's very unique in this market. So I'll say that. And then as a capital provider, none of our competitors in providing lending or equity capital can compare with what we can do. And there's more to say about that. I'll leave that for another time, but we are very unique, and we monetize that uniqueness. We charge about 50 to 100% more actually. And we get it because of what we do. The way we do it is so valuable, to the borrower. So.
Great, thanks guys. All right, we might have time for maybe 2 more questions. So one question that's come in a couple of different forms, Brian, I think this one's a little bit more for you, would be is if you can speak to the company's burn rate.
Yeah, thanks for asking that. There was some discussion on the WeFunder board about burn rate that puzzled me, because some people might be confused about what burn rate is. Burn rate is not how much money the company spends. Burn rate is the amount of company that we spend in addition to the revenue that we earn, so the cash we consume. If we didn't choose to burn cash, and David said it well, we're in a position, and I try to describe why we choose to consume cash. We're doing that in order to accelerate product development and customer acquisition. We're doing that because we know empirically that that's a profitable, investor friendly, like you guys are sharing in the returns of that investment. Burn rate is how much you consume beyond the revenue that you earn. And our burn rate, this year, I think if you look at that chart, it's, we're planning to burn $8 million in capital. We earn, if we go out and spend money to acquire an investor, the data shows that we earn that back in about 12 months. So we put the money out, we plant those seeds, and then we break even on that within a year. Well, during that time, we're burning cash, right? That cash is out. We don't have it back yet. And so if we keep doing that, we get to grow, because we have more investors and we can build product. But, so we're investing a combination of whatever we can raise, plus the profits that are already in the business. And we're going to keep continuing to do that as long as investors will continue to fund our appetite for it, because we see a huge opportunity here. And we want to quicken the path to taking the company public someday. And getting it to a higher level of scale. So that's a quick discussion on burn rate and kind of what it is and how I think a lot of investors think about it, certainly how we do as a management team.
Great, appreciate that. All right, so we've got 5 more minutes to the top of the hour, so I think we have time for maybe one more question. Maybe I'll float it as a 2-parter. I think one of the questions that we've heard a lot, even before this webinar, is what we plan to do, what Ground Floor plans to do with the funds from the WeFunder raise specifically. And maybe I'll call an audible here and add a sub question to that, which is, what might the future plans be for the company that may include those WeFunder funds above and beyond? And Brian, I don't know if you feel comfortable sort of sharing some thoughts there.
Sure. Quite straightforwardly, about 18 months ago, we realized we had enough capital on our balance sheet to accelerate customer acquisition to sort of a new level. And we've been holding that level for quite some time. And we'd like to continue to hold that level, but we're now at a point where in order to do that, we need to refill the coffers, right? And that's normal for a startup. If for whatever reason we don't raise enough, we just simply cut back and that'll show up in lower growth, right? Instead of growing, 50 or 60% next year, we'll grow 30%, right? That's how it'll play out. We have a professional management team here. We have people who know what they're doing, understand the business really, really well, and we have a long enough track record that I think we've been good stewards of capital over time. Now in the future, we'll do this. We fund a raise. You can bet your bottom dollar that we will do another raise next year. God willing, that will be priced at a higher share value. The share value has increased every year now for 8 years since David's first investment. It's increased a lot, and we hope to continue on that path. Now, at some point, we may decide, for example, right before we go public, a lot of companies decide to raise a really large round of capital in order to set them up to sort of withstand that. That would be beyond, I think, what we would expect our customer base, to be able to supply. So someday in the next few years, I wouldn't be surprised if on our way to an IPO, we decided to raise a large institutional round. You have my commitment, and you've heard it here. I've said it elsewhere. Whenever we do that, we will always offer stock to our customers as well. We did that when we raised a strategic round from a strategic investor back in January. We offered it to our shareholders to follow on or participate alongside that strategic investor at the same price. And we'll always do that because we're here for you guys. That's our mission, right? We're not here just to make institutional investors more money. We started in 2013 with a vision about the retail investor, and we'll never give up on that. We never have, and we never will. So that's what's on the horizon. How long does it take to go public? Everybody wants to know. I want to know, how long does it take to go public or exit or be acquired? My perennial answer is always sort of 3 to 5 years, because you're always looking ahead. And that's not just dependent on the company and its performance, it's dependent on capital markets, right? We don't control that. So capital markets are a moving target, but I think we're getting within range of it. We could quote unquote go public today, and you see some crowd-funded equity companies that have done that. I'm personally not interested in listing this company on OTC markets or pink sheets. We're gonna go public when we have a broad enough market for the stock, when we have a scale of revenue that looks more like 100 million, 150 million in revenue, something like that, and where we can demonstrate, a sustained growth rate that will be attractive to the public markets at a level of profitability that's attractive. So, hard to handicap when that'll be. That's our goal, and that's the best way I can answer that very difficult question.
Appreciate that. I think somewhere in there you probably answered about 2 or 3 other questions that had come in as well. So I think that's pretty good. All right, so we are nearly at the top of the hour. So I think at the beginning I had alluded to the folks that have registered, not only attend, but even registered for the webinar. So we're gonna add in a little bit of a kicker. So I'm gonna explain what that is, but don't fret, don't worry about taking notes, because of course Murphy's Law is not allowing me to share my screen here. But I'm gonna explain what the promo is, and then as a follow-up to this webinar, we will send out the details. So don't worry about taking notes. But the long and short of it is for anybody that's gone onto our WeFunder page and have looked at the investor perks, there are 3 tiers. There's a $1,000, a $5,000, and a $10,000 tier, and some perks that you get if you've done that level. So we're going to add a booster to those 3 tiers for just the folks that have registered for the webinar. So anecdotally or commentarily, if you do 1,000 up to 1,000 or more, you will get, Ground Floor is going to give you a $50 investment credit onto the Ground Floor real estate platform as a thank you, in addition to some other offerings like shareholder updates. If you do above 5,000, we are going to do, I believe we are going to do $100 of an investment credit. And if you do 10,000 or more, we'll do $200. So this is not only an opportunity for you as a general investor to come in and invest in ground floor directly via the WE funder, but then as some goodness on top of that to get you engaged from a real estate perspective onto the ground floor platform. We're going to throw some credits your way. And so don't fret, we're going to email you guys the specifics with what this looks like and how to ensure that this this promo gets enacted at the conclusion of the fund and this of the raise. And this was another question that had come in. I believe November 18th is the last day. So we are 30 days out, 1 month out from the conclusion of that total raise. So I'm going to end it there. Look for the email with the details. I really want to give a sincere thank you to everybody that's still hanging on. I see a bunch of you are hanging on here just past the top of the hour. Brian and David, to you especially, thank you so much. And to everybody that has joined, I hope that this time was well spent and that you had an opportunity to really learn something as you start to think about better ways to become a pre-IPO investor and diversify your portfolio. So with that, I'm going to say thank you, and guys, have a great rest of the day.
Thanks.
Thank you.